Hi, good morning. And in case you're wondering, where is the usual pre-market video? The stock market is closed today in Nigeria. Today is a public holiday. So the markets are closed. In place of that, I choose to use the opportunity to do a video on Regency Alliance Insurance H1 2025 numbers. Those numbers were released after trading hours yesterday. And in any case, the stock is on suspension. So you'd have no price movement. Now, before we get right into it, thank you to everyone who takes out the time to like, share, subscribe. Please continue to do so. As always, please note that this is not financial or trading or personal finance advice. And I'm sure for those on LinkedIn, you're probably wondering, not financial advice is the same thing as not trading advice or personal finance advice or investment advice. But remember that my audience isn't just a expert audience. I have everyday lay people who are non-financial people. So it's important to lay out the disclaimer as simple as possible. And you don't have to wait. Coming back to liking, sharing, subscribing. Why do you do so? You do so because it helps with the algorithms. So the more you like, share, subscribe, the more YouTube tends to elevate the video in terms of viewership and presents it to more eyeballs. And you don't have to wait to the end of the video because in any case, a lot of people don't stay to the end of the video. I would suggest so that you do so because I honestly never really know where I would go to in terms of numbers or what I would say or what I'll do or just generally dive into numbers. So it's always nice to stay at the end. I try as much as possible nowadays. I mean to keep my videos within the 7 to 10 minutes mark because attention span, I think that's the max or the most optimal videos tend to be. Now, H125, the first 6 months of 2025, if you are from Spotify, and if you're not on Spotify, you're not following the podcast on Spotify, the Green Ticker Deals podcast, you're missing out a lot because I tend to be a bit more granular sometimes with the Spotify content. I mean, for instance, I have Q1, I think I have Q1 2025 numbers there on this same firm. I think I have audited FY 2025 numbers there. Let me check as well. So, I mean, if you're not following, you should follow all of them because um, Spotify tends to give room for more content. I mean, I was looking at my analytics, and very few people, I dare say, not many people in this market tend to have videos at this time, really. So I did a Q1 number. It's odd I didn't do FY24. Okay, that's fine. I might as well do Q2 for this firm. So before the day runs out, Q2 25 numbers for Regency Alliance will be up on Spotify. But let's dive into what we have in front of us. So now you can split the key components of an insurance firm's results. I would say you have your insurance revenue, and then after you deduct all the insurance service expenses, all the insurance expenses, you have your insurance service results. So you can see here that insurance service results fell sharply. And why is that the case? Insurance expenses, service expenses went up. So 5.7 billion in insurance revenue after deducting all insurance expenses. You have 299, essentially 300 million in insurance service results, which is poor, but it's understandable, and that's the thing about insurance. Some years you have really low claims and expenses. Some years you have really high expenses. So it seems like 2025 seems to be one where expenses are high. I think what I will do, and I have the numbers. I didn't want to have too many numbers here so people don't get confused, but I can probably do this on my Twitter page is to put Q1 numbers and Q2 numbers side by side. So I'll do that sometime, maybe today or tomorrow. That way one can have a granular view of where is the pressure in terms of insurance service expenses coming from. Is it from the first quarter or the second quarter? And that. So, and beyond insurance service income, if I can use that term, one also has investment income. Now, investment income went up marginally, pretty decent. A trend I see with insurance firms, a lot of insurance firms, investment income tends to be more um, than insurance service income. And one thing this firm does, I think they do a great job of disclosure, is somewhere if we go through the financials, you can see the split between investment income from shareholders' funds, investment income from premiums collected, and the likes, which is a great split. To the best of my knowledge, maybe I'm wrong, but I think they're one of the few firms, if not the only firm, that does that. So investment income up, insurance service results down. You merge the two together, what you have 1.1 billion net insurance and financial results. Um, that's not so bad. It's down 27% or 28%, but understandable because of the pressures, I would say, from claims, expenses, and all that. So what do you have? H1 2025 earnings per share of 3 naira 3.6 kobo. I beg your pardon. Um, and it's down sharply, but understandable why it's down. So in all, the numbers are pretty decent. I quite like the numbers of this firm. So let's go to the buy, sell, or whole thing. I think a lot of people just want to jump into this. Should I buy? Should I sell? Sharehold? As always, and I put the disclaimer again. Please do your own research. That's the meaning of DYOR. And in case you skip that, I still have a sentence again. This is not financial investment or trading or personal finance advice. You need to do your own thing. Now, in arriving at my view, and clearly you can see my workings, the first thing to say is, what's the book value of this firm? Book value is what you have when you deduct assets from liabilities. So you have a book value of 14.2 billion, and that translates on a per share basis to a book value per share of 1 naira and 18 kobo. So book value essentially means that if I deduct liabilities from this firm, what do I have? What in essence is the core, I would say, the juice, I might say, if I deduct all liabilities and all that. So I have a book value of 1 naira and 18 kobo. Current price, stock last traded at 1 naira 30 kobo. So it's trading as slightly above book value. Or to put it in simple terms, current market cap, I think if you want to get that, you multiply 12 by 1.3. What does that give? 12 by 1.3. So current market cap of what? About 15.6 billion, book value of 14.2. So it's not expensive really, because it's just trading at about 1.09 times book value. You have several stocks in this space trading at 1.2 times book value, 1.7 times book value, way higher, and the like. So it's not pretty expensive. But the clarity I need and why I have a hold recommendation is I'm awaiting clarity on if slash how much capital will be raised by this firm. That one doesn't know. I guess we'll have to know when the company holds its annual general meeting, and they've not yet to give notice for that. So the trend I've been seeing is that, I mean, you've seen firms raising capital. So the question is, how much capital would they need to raise? I don't like to speculate because insurance is a highly specialized space. I mean, with the banks, it was easier to figure out how much capital they need, but insurance firms are a bit more technical. Now, in terms of return on assets and return on equity, um, these numbers are a bit poor. Really, these numbers are a bit poor. And with I think it was Investor Insurance, the podcast are there on Spotify. Now, let's try to estimate that if this performance is repeated in the second half of the year, and what are you going to have? So let's assume this firm ends the year with 500 million in, which is tiny, 500 million in profits, and you divide that by its equity. So that tells me that that's probably what 10% of 1.4 14 billion is 1.4, so 500 million is just under, that's like a 5% or uh 3-4%. So if you have the same run rate, so you have a 3-4, let's say 4% return on equity, that's rather poor. Or return on asset, rather, 4 billion return on asset, 4% return on asset. uh, no, 4 billion, 4% rather return on equity. Equity is essentially capital you use to run the business. So that's 14.2 billion. um, and all that. And of course, you have capital, part of equity is capital injected by shareholders as well as retained earnings and the likes. Now, let's look at return on assets. Return on assets for these firms are rather going to be poor because if you have, I mean, to put it in simple English, you have 22.4 billion in assets and you're generating 500 million. I mean, I don't even need to do the math for you. That's rather poor. I mean, that's probably less than 2.5%, so maybe 3% return on assets. It's rather poor. So if you're going to look at this stock from that angle of ROA, ROE, um, these numbers aren't fantastic. They are more compelling firms in this space. I mean, if you refer to the last couple of videos I did on insurance, I think you have the likes of your AXA Mansard, your custodian, your name. Return on assets and return on equity is way much better uh, than this firm. And just in case you are wondering what return on assets is, uh, in simple terms, for every how much uh, how much per naira is generated for the assets this firm has had, while for return on equity simply means that for every, say, X in equity that this firm has, how much is generated, how much per dollar or per naira is generated by the firm. So clearly, these numbers, I mean, from that angle, these numbers are quite poor. But if you're looking at it from a valuation perspective, which is to say book value, um, book value, this stock is inexpensive. And I suspect, I mean, it depends on how it goes. If markets react accordingly, then you simply might might see a dip. So in simple terms, and just to round up, return on equity simply means the amount of profits generated for every naira of shareholders' funds invested. And so if you're working, that means that it's what uh it's 1% return on every dollar or naira invested. A 1% return, or even if you say it's a 2% return, it's poor, because the question you want to ask yourself is, in a high inflation environment like Nigeria, ideally, in my view, your return on equity should be somewhere between 15 to 20%. Worst case scenario, 10%. But 10% is poor because inflation is in the mid-teens. So you need to be doing maybe 20%, 15, 20%, in my view. So even if you round it up and say return on equity is 3%, return on assets is 3%, there are better options from that angle. So that's pretty much about it. Thank you all for joining. I'll see you in the next video. Next video should be up by 6 p.m. West African time. I'll be looking at universal insurance. I'm not decided yet if I'm going to do a video on PZ. I don't know yet. I may or I may not. But one setting is inshallah the video on universal insurance. That video will go up by 6 p.m. West African time. Have yourselves a good holiday if you're in Nigeria. If you're not in Nigeria, hope you're having a good productive work or business day. Whatever you're up to, stay well.